Yes, the recording has started. Thank
It is
you.
starts, sir.
Yeah. Thank you. So as all of you can see, uh, it's called bidding and auction design. Now, the idea is auctions are as old as human. It dates back to Greek and Roman civilization, where they used to auction slaves. So the healthiest slave fetches the highest price and so on. And you can find those, what I can call, examples or anecdotes in classic novels and some old English movies. Anyway, when it comes to the formal analysis, it is not very good, hardly 50, 60 years old, not more than that. This is 50, 60 years is a lot of time, I understand, but economics as a discipline has started, say, from 1776 formal. So in that range, it is pretty new. And the person for to whom we can actually be grateful is Professor William Vickrey. Now, this part, why this auctions, bidding, this just comes after the lectures on pricing, because it is nothing but again something to do. In fact, the final price that one pays. And this final price which is being paid comes or is realized through what we call competitive bidding. So far, when pricing was concerned, we have only looked at the pricing strategies of the firms. Here also there will be certain strategies of the seller. But here in this analysis, when we talk about auction, the focus will be more on the consumers or the people who buy. In fact, all of us knowingly, unknowingly participate in auctions, online and offline. So if I give an example of offline auction, you'll understand that online is already there. Take for example, you go to a supermarket to purchase something kept on the shelf. Okay, you go there every day. Now the price changes over time. Either it increases a little bit or there are discounts. Why? Basically, the concept of stock clearance has a lot to do with the idea of auction. And auctions actually affect our life. At the end of the day, the price you pay for your mobile phone depends on the auction of the 4G spectrum. And there is a typo, sorry for it, let me immediately change, and the recent Air India. So what will be the prices when you fly from, say, Delhi or Mumbai or Chennai or say Ranchi to Kolkata when the campus reopens? Not only Air India price, but because the 18,000 crore bid by Tata Group, winning bid by Tata Group to acquire Air India, that will also affect the pricing strategies of Indigo through the pricing of Air India. You can understand now, because in our previous lectures we have made it clear that whatever the price of Air India is will have a direct or indirect bearing on the prices of Indigo, SpiceJet, and whatnot. But what will be the pricing of Air India is also contingent upon the winning bid amount 80,000 crore. Because that has been calculated through a projected profit maximization objective function. Right? Now, auctions has three very important features. And I will briefly spend a minute or two to explain the terminologies used. The first thing is existence of asymmetric information between seller and bidders, and as well as the asymmetric information within the bidders. What is asymmetric information? The set of information which is available to you is not exactly the same set available to me. You might have a little more information than me. Now, that is exactly what we call asymmetric information. Now, suppose I know that I have more information, and if that information pertains to me, and if I can share it with others somehow, then that will somehow maximize my payoff or increase my payoff. Then what I will do, I will try to signal that. And suppose I want certain information. I know there is a lot of information. I exactly cannot understand what to do with it. So I use some screening methods to understand exactly which signal is a correct signal and which signal is a misguiding signal or misleading signal. The second thing about auction is that when we talk about optimal strategies among bidders on sellers and bidders and sellers, these optimal strategies depend on the levels of risk aversion. Now, what is risk aversion? Whether we all take, for example, I have certain income which varies over the state of time. Suppose I'm a farmer. Very, very simple example. Suppose I'm a farmer. If the crop is good, my income is Y. If there is a crop failure, my income is zero. Right? So what I can understand that my income is uncertain. So there is certain uncertainty related to my payoff. So how much I am tolerant to that uncertainty? So there can be three categories. What is risk neutral? So basically, I do not care about risk at all. Or I'm averse, or I'm lover. If I'm a gambler, I always focus on the highest payoff and ignore the least payoff. Then I'll be basically what I call basically a risk lover. And I will just ask all of you to imagine a simple diagram in front of your mind. In the horizontal axis, put income. And in the vertical axis, put something what you call utility from that income. I am not consuming cash. My income comes in the form of cash, say, or bank balance. So there is a number against the account I hold. Right? I do not consume that. I spend that money on certain things and get utility out of those consumptions. A set of commodities and services. Now look, if I'm poor, a very little increase in income is more important than same magnitude in increase in income if I'm rich. So suppose I'm very, very poor, 1,000 rupees additional income will create a lot of positivity in that human being who is poor, but 1,000 rupees income in addition to Ratan Tata will not make any difference. And this is exactly what we call diminishing marginal utility of income. So when I say that, just imagine a particular space in front of your mind, that in the horizontal axis I put income, on the vertical axis I put utility out of that income. You can actually have three types of graphs. One is a straight line, and this is what we call risk neutral. So as my income increases, my utility increases proportionally. But if I have diminishing marginal utility of income, it will be increasing at a decreasing order. If I'm risk lover, it will be increasing at an increasing order. So the degree of aversion to risk has a lot of bearing on the optimal strategies for people. And finally, what is expected payoff? When I have uncertainty, as I just mentioned, that suppose with 50% probability I might have no income, with 50% probability I have 100 income. So my expected income will be 0.5 into 0 plus 0.5 into 100. So 50. That's what we call expected income. Similarly, the payoffs, given different probability distribution, you can calculate, and that's exactly what we call expected payoff. So I have defined what expected payoff is. Now the statement that given certain specific circumstance or circumstances, this expected payoff to the seller as well as the person who wins the bid are same across auction types. That brings us to the question, what are types of auction? Now, types of auction depends on the method which is used for bid submission of the bid, and hence the determination of the final price, which is to be paid by the winner. Now, this particular aspect, that how this auction bidding is done and what should be the final price, is set by the seller. And these are what we call auction rules. So apart from auction rules, there is something called auction environment. And this environment also is used for determination of the types of auction. And that in turn depends on the type of auction, which is type of object which is being auctioned. So let's get into the auction rules. So as we said, the seller determines the auction rules. And when she sets these auction rules, she has only some limited knowledge about how much the bidders are willing to pay. So look, she does not have complete knowledge. And this is exactly where asymmetric information comes to. There are four major categories of auction. The first is open outcry. Open outcry is all the bidders come together and cry out their bids. Within open outcry, there can be two categories. So out of the four major categories, two categories belong to open outcry section. One is the English auction, where which we have said that there is an antique to be auctioned off, people start quoting, and I overbid you, then you again overbid me, and then someone else overbids both of us, and it goes to the highest bidder. So it is an ascending, starts with low price and keeps on increasing. The second category of open outcry is the Dutch or the descending. Here basically the seller starts with a very high price. If you accept, it's sold. If you do not accept, then the price comes down, coming down. And this is exactly what we see when these mega stores, departmental stores come up with discounts. Okay, look, you have already participated in auction without knowing, because you have done in a Dutch way. The second category is again what we call the sealed bid auction, and there are two subcategories: first price and second price. The sealed bid is I submit my bid privately, and no one else apart from the seller can see it. And that person is known as an observer who opens the bid and determines who is the winner. The first prize sealed bid auction is the winner has to pay a price which he or she has quoted. Suppose everyone has quoted a price, then it is auctioned off to the one who has quoted the highest price, and this winner is to pay the price he has quoted. The second prize, sale bid auction, which is also known as the Vikray auction, is the same thing, but the winner has to pay the second highest price, the price quoted by the second highest bidder, which is called second prize sale bid auction. Okay. Now, let's think about now. These are the auction rules. Now we come to auction environment. Now, auction environment, there is basically two major distinctions: whether it's a common value object or it's a private value object. What is a common value object? Or what we also call objective value auction. The value of the thing which is being, or the object which is being auctioned off, is common to everyone. Take for example the 4G spectrum. Everyone knows the value, though everyone has some imprecise estimate of it. No one knows the exact value. So take for example, when this Krishna Godavari basin was auctioned off, oil exploration, everyone had an inkling that, okay, this should be the reserve, without knowing exact estimate of the oil reserve. And here, signaling and screening will play a role, as we'll see later. Second thing, okay, one more thing about it, that in a common value, I have an estimate, you have an estimate, and the estimates might be correlated. So my estimate has a direct bearing on your estimate. Okay. The second type of environment is when we deal with private value or subjective value auction. Here, everyone has an individual value attached to that object. So the example is, suppose a gown worn by Princess Diana or Diana, whatever. It might have a very high value for someone and might be completely valueless to you. An antique piece. Okay. Now I know what value I attach to that particular object, but I do not know what you have attached. So information plays the most critical role in this bidding strategy. Because from a seller's point of view as well, look, what will he try to identify? Two things. One, what are the true values people attach to an object? Two, what is the highest value? And hence, I can exact the best price for the thing I want to sell off. So when you basically put the picture of your old scooter in OLX, you are actually participating in an auction. Now, there is something which is a caveat to auction. And this is what we call a winner's curse. Now, before telling you what is a winner's curse, let me try to give an example. Suppose there is a particular company called TargetCo, which you want to acquire. You believe that the present value of this company is around $5 billion, but if you acquire it under your management, it will become $7.5 billion. So what you can beat is somewhere between 5 billion and 7.5 billion. That will make you profitable. Because if you think it's uh, not less than $5 billion, then you will not put a bid of less than $5 billion, because then the present management will not sell at $5 billion. Right? So if the present value of TargetCo is more than your bid, then they will not sell it off to you. So suppose you bid an amount B, small b, and you expect what? The current worth is B by 2. And if your bid gets accepted under your management, you will have 50% more. So it's 0.75. 0.75B is still less than B. So basically, the winner pays something which is close to the least value. So basically, you have to when you have to set a bid and you want to win it, the winner actually plays a bid which will give him a value in return which is very less different from the actual value of the bid. So the seller will exact or try to siphon off as much as possible from the bidder. And a very common experiment, classroom experiment, is there is a transparent jar full with coins. Okay. And it is being auctioned off, and the person who is running this experiment will say the students that, okay, just think how much value of this jar is. And the jar full with coins will go to the person who gives the highest bid. In general, it has been seen people actually bid more than the value. Okay, and this is what we call a winner's curse. Now we come to what we call bidding strategy. Now, what is the English auction? Open outcry, ascending. So the highest bidder gets it. Suppose you value the thing to be auctioned off is B. This is your private valuation attached to that item. And the rival means who is closest to you, bids R in an open outcry, right? So you can observe each other. Now, if the value you attach is less than R, then there is no reason for you to bid. If the value you attach is greater than R, then you add a small amount. Say particularly, suppose the auction rules will specify how much you can increase the bid to overbid the opponent. So there is always a particular unit. Say that is 1 cent. So you just add 1 cent to R. So R plus 1. And you give your bid. So you win, but you pay. And suppose you win, your rival bid is R, and you add 1 cent to it. So you pay a little more than R, and your effective profit is V minus R, right? Because this is the value you attach. You have paid 1 cent more than R. So, and suppose we have rounded off because 1 cent is a minor amount. So effectively your profit is V minus R. Now first price sealed bid. Will you bid V? V is the value you have attached. Now if you bid and your bid comes out to be the highest, then you have to pay V. So your effective profit will be zero. But if you place a bid which is less than V, you might not get it. But if you get it, you still have a positive surplus, V minus R. And this is what we call incentive to shed. Even if value the good at V, you place a bid which is lower than V. And this is what we call shed. And what is optimal shading? Optimal shading is the strategy which balances your increasing profit margin, which is your advantage. Because if you bid substantially lower than V and you still win it, then V minus that, which you have your winning bid, suppose that is K, will increase. It will increase as much lower bid you have submitted as winning bid. But the moment you lower, your chance of winning also goes down. Someone might overbid you. That's the disadvantage. So advantage and disadvantage that you have to balance, and that is what we call optimal shading. Let's come to Dutch auction. What is Dutch auction? Open outcry, but dissenting. If the auctioneer quotes a price which is greater than B, he will not bid. If there is a particular taker at that price, that thing will be sold of that person. You have nothing to lose because the thing was sold to a particular person, a rival of yours, who has a higher valuation. You will not be able to afford. You will not spend that much money. You have nothing to lose, nothing to gain. But suppose there is no one at that price, and the auctioneer, what he does, drops the price. And suppose he comes to a value V. He quotes a price V. Now you can bid, get the thing at V, but you have zero price profit. Or you can wait that the price drops a little bit more so that your surplus is generated. It's exactly like the first price till bid auction. You have an incentive to shift for the second price till bid auction. Without wasting any time in this particular slide, let me directly go to this statement that under this second price till bid auction, every bidder will have a dominant strategy, which is bid your true valuation. So there is no incentive to shade. How? Example. Suppose your valuation is $3,000 and you have no idea about what are the valuations of others. What you know, everyone will submit their bids in sealed envelope, and the one bid which has the highest amount, that will be declared the winner. But the winner will have to pay a price which is the second. So suppose your bid is small b and the largest rival bid is smaller. Now let's compare small b, smaller, and your valuation. So you have to take the first case. What is your bid is more than $3,000. So you place a bid which is more than the valuation you have. Three cases. depending on R. So suppose R is less than 3000. The rival bid is less than 3000. You have placed a bid which is more than 3000, but R is less than 3000. So you win and you pay R. What is your profit? 3000 minus R. Valuation minus what you pay. So if that is the case, there is no reason for you to place a bid which is more than 3000. Right? Now, second case. The rival bid R is less than yours, but it is more than 3000. You have placed a bid B, which is more than 3000 and also more than R. You win, but you have to pay R. But R is greater than 3000. So it's a loss. You have lost R minus 3000. If you had placed a bid equal to 3000, then your rival would have won, but you would not made any loss. So it is better for you to place a bid which is 3000. Finally, your rival bid is more than your bid. You do not win. But the same would have happened if you have placed B equal to 3000. So now look, in all these three cases, you can see it is better for you to place a bid which is equal to 3000, which is your valuation. Now, second case, you have placed a bid less than 3000, right? There's a two cases. You can place a bid which is more than 3000, place a bid which is less than 3000. Again, there will be three cases. Suppose rival bid is less than your bid. You win, you pay R. Your gain 3000 minus R would not have made a difference if you had placed a bid equal to 3000. B less than R, you lose. But R suppose is less than 3000. If you had made a bid for 3000, you would have won and made a profit of 3000 minus R. So it was better for you if you had placed a bid equal to 3000. Now R is more than 3000. You do not win, but you getting a bid which is equal to 3000 would not have changed the result. Again, better for you to place 3000. So look, with all these three sub cases for the two case, the two possibilities B, your bid more than 3000, which is B more than your valuation, or bid less than your valuation are the three sub cases, as compared to your rival, shows that in all the cases, it is best for you to place a bid which is equivalent or equal to your valuation. And this is exactly what we call rigorous truth serum. So, in a second price sale bid auction, reveals the actual value each bidder attaches to that object. Okay. Now, buyers or bidders are not the only party in an auction. You have a seller who sets the rules, and seller will also try to maximize her profit. Now, a seller might think whichever process I might implement, whichever rule I might set, English, Dutch, first price, second price, sale bid, whichever, out of the four, whichever type I might set the rule, I might not get a price equivalent to the value I, the seller, attached to the object. But to counter this problem, all the sellers in general, keep a reservation price. So, what is a reservation price? I have a right to withdraw the object from auction if there is no winning bid matching to my reservation price. And as you can see, that was exactly done by Government of India regarding the auction of Air India. For the last years, all these years, they could not get the reservation price, and that is why Air India continued with the Indian government. Okay, only now this particular time, the reservation price has been crossed, and the Tata group would place a bid which is highest among all the bidders, and they have won the bid. Right now, you have a reservation price, and given the Vickrey theorem, you can opt for the second price ceiling option. But does these maximize the seller's profit? Because look, even if you implement the second bid, the second price sealed bid auction, suppose the winner has the value $3,000, but he pays R, which is less than $3,000, which was the second highest bid for it. But in doing so, the seller could reveal the maximum willingness by everyone. And suppose the reservation price was 2,000 and R is more than 2,000. But does that maximize the seller profit? Now, basically, which type of mechanism is best for the seller? That depends on two things. As we said earlier, the attitude towards risk by all the bidders. And something where this thing becomes a little tricky, the belief about the value of an object. Now, as I said, the risk neutral people. The risk neutral people are indifferent to the uncertainty. They only care about the expected monetary value. Now, if I talk about independent estimates, what is independence? That one bidder is not influenced by the estimates of the other bidder. Now, in these conditions, so if you have risk neutrality and independence of estimates, the average revenue will remain the same across all the four rules of auction. Okay. And this is what we call the revenue equivalence. Now, look, take for example the second price auction. It's straightforward. The winner is the bidder with the highest valuation, which is true, but pays a price equivalent to the second highest bidder. English auction, same. But he gets, say, a cent. Remember, we said suppose the minimum amount which is being allowed by the seller to over trump the opponent bidder. So if it's very minor, then again that 1 cent will not make it's almost the second highest bid. And you can look by logically, you can have the same things for the Dutch at the first place. Now, what's the intuition? intuition is in all these four categories or types of options. If there is no risk aversion, what is risk aversion? That a person or a bidder is averse to any uncertainty. If that is not present, then the highest valuation, the bidder who gives the highest valuation wins and on an average pays a price which is equal to the second highest valuation. Now, this is the theory part. Now, we do have certain evidence. One is experimental evidence. That's classroom experiment or any experiments done on a societal scale, social experiment. When you do these experiments, in general, what have been found at Dutch auction, which is open outcry descending, this price fetches a price lower than the first price sale bid auction. So if I'm a seller and if I want to have evidence, then this experimental evidence shows that it's better for me to choose the first price sale bid rule over the Dutch auction. And there is a little bit of overbidding in second price. Why? Look, though we have said that suppose R is less than 3,000 and you have placed a bid which is more than 3,000, you win, you pay, your profit is 3,000. You would have made the same payoff by quoting bid equal to 3,000. This is theory. But in experiment, people tend to bid a little bit more than 3,000, believing that others will not match. And hence, I will have that job. So overbidding is there in second place. Now, field or internet, online auction evidence. Now, the problem is exactly opposite to Dutch, the experimental evidence. Dutch prices are 30% higher than first price auction. And revenue equivalence not found. So these are the domains which I guess Professor They will shed more light when he takes over. Now, let's come back to this idea of risk aversion. And we continue with our assumption that my estimate or my belief, my guess is not correlated with yours. What is a risk averse bidder? The bidder is more concerned about losses, which is I underbid, I lose the object, than the cost which is associated to the bid he places close to the true valuation. So if I'm risk averse, let's think about a Dutch auction. The price follows. The moment the price nears V or touches V, my valuation, I know I can wait, I can shade a little bit. But if I'm risk averse, then I'll not wait. So with risk averse bidders, there will be lesser shading. So when these bidders themselves are risk averse, what is risk aversion defined? That if I'm a risk averse bidder, then I will try to get the object, even if the price I have to pay is close to my valuation, and hence my net profit is very, very low or maybe zero. As in the case of Dutch, it will be zero. In the second price sale bid auction, it will be near zero, but positive if I win. But the seller does better with a first price auction or a Dutch auction, right? Now, let's come to correlated estimates. So far, we have not said the estimates are correlated. Now, when I'm saying correlated estimates, that means we are in the domain of a common value option rather than private value. So far, we have talked about private value. You must have understood by now that my valuation is different from your valuation. Now we talk about, say, uh, auctioning of an oil field. Now, you are also concerned about the estimates your rivals have. Whether the estimates are very similar to those of rival, this is what we call positively correlated. Now, it might also be that uh, my estimates are quite different from that of yours. Now, if the estimates are positively correlated, then in first price auction, just think intuitively. It's very simple. That if my estimate of the common value object is directly correlated to your estimate, then if we go for the first price sale bid auction, then if the estimates are correlated positively, the shading will be higher. Or lower, because if the estimates are positively correlated but optimistic means that our estimates move in the same direction, in the upward direction. So if it is positively correlated, then look, the second price auction is better for the seller, because the estimates and hence the bids by these bidders will be very, very similar. So he will lose much less. And because second price reveals the true valuation of the bidders, he does not lose much. But these estimates of the same thing are positively but pessimistically correlated. Means both of us think that the value is actually low. We'll not get much gas or oil from that field. Then both will place very, very low bids. Then first price auction is actually not a good option, because all of them will place a bid much lower than the true value of that. So look, this correlation of estimates has a lot of bearing on the profit of the seller. Now take that you are bidding on an oil field in an English. English is open outcry, ascending. And the price which is being auctioned is nearing or almost touching the estimate that you have placed uh, in your mind. But you are observing that your rivals are still bidding. Then you might think, okay, my estimates might have been wrong. All these rivals are bidding feverishly. Then I must have made a mistake, and my estimate was an underestimate. I have underestimated the true value. So now I have added information from the signal which I observed from the corresponding bidders, right? And your rivals actually convince you that your estimate is good. And now you might actually revise your estimate and again re-participate in the bidding. So this English auction will be better than the first price, because in the first price you don't have an option to revise and resubmit the bid. So if the auctioneer, the seller, understands that the estimates are correlated, and if the signal of one bidder says that the true value of the common value object is higher than the rest, the others will try to revise. And hence, this English auction would be a better option for the seller. Now, what about the estimates are negatively correlated? This I leave to your judgment or your own thought experiment. It will be exactly the opposite. My estimate is negatively correlated with yours. I think I will do exactly the opposite you will do. Then what is going in my mind? In my mind, it is going that if you are placing a bid which is high, or if you are placing an estimate, you are signaling an estimate of that common object as high, then it must be low. You are trying to trap me. Then the English auction will not do good. Because the moment I see my rivals are feverishly bidding, then I said, okay, I'll do the opposite. I'll abstain from bidding. In that case, the Dutch auction will be a better option for the seller. Because the moment the price is quoted by the seller, if it is not matching to anyone's, he will just bring it down. Someone it will match, he will quote for it. In that case, the seller can maximize his profit. Now, there are certain extensions to the theories that we have broadly discussed. One extension is sometimes it is observed that auctioning a group of objects together is better for the seller than selling it differently. So particularly, and it's also sometimes the bidder, also the value of a package of things is more than the sum of if all these individual things are auctioned individually. And classic example is a land. If there is a big piece of land and you are auctioning it among probable developers, the developers will prefer the entire land rather than the small plot. There is one more extension in a different dimension altogether. There's a collusion among bidders. And this we see a lot. There is a one large bid followed by very small bids. Then what happens? Particularly in case of second price auction, the bidders might call you and say, okay, let's buy it cheap. Keep 3, 4 bids which are very, very small, maybe a little above the reservation price, and put a bid very large. The winner will be that large bid, but he has to pay this very small price, which is the second bid. And if it's a sealed bid, to protect the cheater's identity. But I'm not trying to confuse you more, but this is basically what you're talking about, a collusive behavior among bidders. But this in turn is might be vulnerable because it is one winner who pays the price of his nearest rival. Why should the rival quote a bid which is very, very small and make the other person, the winner, have that much surplus? So if there is a surplus, there has to be a distribution rule of that surplus. That is the topic for negotiation and bargaining. Okay. And that we'll do a few lectures later. There is another thing which we call shilling. Shilling. Basically, the seller himself puts false bidder who basically jacks up the price. In an English auction, there is a bidder who is actually not an actual bidder, but he's actually working on behalf of the seller, trying to push the estimate of that item. And there is something which has legal implication called information disclosure. If the private information is the seller, then it is better for him to reveal, because then that will correct all the estimates of all the bidders. Okay, because even if it's a positive information, we understand that will put the estimates on a higher note. But even if it's a negative information, that is also or should be disclosed, not because of legality, but because of the seller's own profit. Because if there is something negative about it, then through correlated estimates, you can understand the final bid might be much lower. Okay, exactly 6 o'clock, and we stop. And this is your brief introduction to auctions and bidding. And Professor, they will pick up from here and have a couple of lectures on this topic. So please go ahead if you have questions or anything, any doubt or anything, any observation. Please share. And I will send all the slides. And as you just saw that the last slide is the reference with the exact chapters and everything. So everything I share today. Preferably through ERP so that everyone receives the email. And please inform me if you are unable to get hold of the reference. Then I have to somehow arrange for it through our through Shanton or Ravi Teja. I will try to do that.